Hello and a warm welcome to Talking Stocks. I'm Gugulethu, Cele. Also in studio, I'm joined by Peter Armitage and Bryan Rudd, both from Anchor Capital. Now today we're talking a New York Stock Exchange listed company, Blackstone. It made financial news recently when they sold off the icon New York hotel, the Waldorf Astoria, to Chinese company Anbang for almost $2 billion. Maybe you can give us more perspective here, Bryan, before we lose the property spin and start thinking jewelry. Who is Blackstone and what do they do?
Well, Blackstone is the second biggest alternative investment manager in the world. They've got roughly 290 billion in assets under management and play across 6 key areas, but predominantly in 4. So you're looking at hedge funds, private equity, real estate and credit are their main assets under management there. Very big business, been around since 1985. It was started by Stephen Schwarzman, who came from another company called KKR. And the first iteration of that, people will be aware of Barbarians at the Gate. KKR was one of the investors in that book and the movie. But yeah, alternative investments, really driving the other side of the market, not your traditional unit trust or your mutual fund.
On the metric side of things, I understand a market capitalization of 44 billion. That does put it into perspective. This is a huge company we're talking about.
Very much so. You're looking at a company, as we've said, 44 billion, very attractively priced at the moment on a forward price earnings of about 10.2. And that's, to put into context, is roughly in line with its long-term average. So it's a very attractive price. It's not really an expensive business. It's never going to be a 30 or a 40 multiple company. However, we sit there and still think this 10 is actually very attractive, especially on a forward basis. Unbelievable yield on this company. You're looking at 8% dividend yield. They don't need the money. They don't need to retain money at the core of the business. So it gets all returned to shareholders. They've got over an 80% payout ratio back to shareholders. So as I say, there's not much you can fault on this business. Margins are fantastic, operating margin of excess of 50%, and that margin opening. So yeah, you can't really pick holes in this business from a metrics and an operating perspective.
So we get the picture that you like it, but Pete, from your perspective, is there more growth opportunities within this firm?
First of all, just to clarify exactly what the business model is. They don't own these assets. So they take other people's money and invest it for them. Now, what I particularly like and find quite exciting with this business is it's a private equity type business. So they're taking people's money for anywhere between 5 and 7 years. So somebody gives them their money, they can go through cycles. They can take 5 to 7 years to get a decent return out of it. They charge a management fee on managing that money, and then a performance fee if they get a return above that. So if they're able to time the cycle right, buy assets at the right price, it's money that's stuck there, even if conditions are poor for a year or two. Unlike a traditional asset management business, people can withdraw their money. The money's locked in for periods. And another huge competitive advantage and why this business is particularly interesting at the moment, and has been for the last few years, is the new banking rules, the Basel rules, which everybody talks about around the world, have made it unattractive for banks to own private equity businesses. So banks have kind of moved out of this space. So in terms of the buyers for assets, that's reduced in terms of the number of buyers. And so Blackstone should theoretically be able to buy assets a little bit more attractively. They've got less competitors out there. And for people who are wanting as opposed to South Africa, where people are quite nervous of hedge funds and alternative investment, it's very much part of the psyche in America, where people have a portion of their asset allocation in a business or in alternative assets. And the options for investment in it, in a well-respected fund manager with a track record, have become limited because banks aren't doing it. So you've got the competitive landscape has improved for them. They're sitting with a lot of powder dry. So if prices do come off, they've still got the ability to invest.
Powder dry?
Well, powder dry, it means if you've got gunpowder and you've still got powder in your gun to shoot your gun, they can still buy a lot of assets. So they're well positioned if they find attractive things. I think probably the only negative about it is its size. That has advantages because it means you can do bigger assets and compete in spaces where the rats and mice aren't playing. But ultimately, a business that's $44 billion, if it was $4 billion, you can grow a lot faster. So don't expect rampant growth out of this thing. But there should be some solid returns. because of the performance fee element and the type of business that it is, for some reason, so there will be cyclicality. So as soon as that's the case, the market brings the P multiple down. So the valuation on it, I think, will never really be particularly high. But you've seen the multiple you can buy it, which means your risk is quite low. And, so I think people are concerned the performance fee element, which is particularly strong, is quite high at the moment. So people are saying, well, that can get squeezed a bit. But even if it does, then you're still getting to a normal valuation. So we think it's probably been discounted too much for the good earnings that are there. I know that sounds kind of counterintuitive. But ultimately, the cash that they're making, they're paying out to you as a dividend. And globally, where you're scratching around for 1 or 2% returns on bonds, an 8% dividend yield is incredibly compelling.
So we like it for the dividend, and I understand 2014 was an incredible year for this company. Revenue shot up by more than 14% rather, and earnings per common unit also up by over 20%. So clearly they're doing something right, or the market's just working for them at the moment.
Very much so. I think it's they're doing things right. They're realizing a lot of some of the assets. They've moved away from certain key areas. You mentioned the selling off the Waldorf Astoria. They've also recently agreed to sell the MetLife building in New York, which is, if everybody sees the New York skyline, they'll see the MetLife and they know which one we're talking about. And they're doing that for about $2.2 billion. So, they're realizing returns, they're realizing investments, and it's a company that just does it right. And again, when they're getting the assets under management, they're getting a fee on that assets, their costs are staying fixed. So this generally has a characteristic to drop down to the bottom line for the company.
You mentioned the sale and also the disposal and purchase of real estate, and that's clearly where the main revenue driver is coming through. And Pete did allude to hedge funds, which for South Africans is still slightly taboo.
It's an area that's growing, but I think when people think hedge funds, they think, wow, it's these guys who just go and punt whatever they want and that, where it's not necessarily the true reflection of what a hedge fund is. So real estate is a big driver for these guys. They went in very, very hard in 2007, 2008, when markets actually came off, and the real estate gave them great opportunities. The Waldorf Astoria, as well as the MetLife building, were part of a portfolio they bought in 2007. They've managed to receive a great yield on that investment. And they own nearly 48,000 single family homes. So like the house you and I live in, they own 48,000 of them.
Sure.
So it's an area where they were very big in the real estate. They seem to be moving slightly away from that now and looking at new opportunities, specifically through your energy, for one instance. So it's a big driver. It's grown as a very big contributor to revenue recently, but I do expect that to taper off a little bit more. But saying that, there's other areas that are picking up the slack quite comfortably.
And I think that 50,000 houses is quite significant. The US, despite the GDP growth that's come through in America, house prices have still remained quite subdued. If you as a South African go over to a normal American city, you'd be quite surprised at what you can buy a house at. And there's been quite a low level of new household builds in America. It should be 1.5 million odd a year, and it's been kind of between 500,000 and 1 million per year. So over a time period of the next 5 years, my personal view is that the price of houses in America should have some quite nice upside as GDP growth kicks through. And they're quite nicely positioned, so they've bought stock of that. And it's a nice play. If you see housing in America starting to kick up, you should. This company is a nice place to be.
Which makes sense, because it has been managing to deliver sustained performance over the last couple of years, especially since that 2008-2009 dip.
Well, that's it. If we look at the chart on the screen, we really wanted to highlight, this comes from one of their presentations, and we really wanted to highlight this unbelievable growth that they've managed to sustain over the last 5-6 years. When you're growing your revenue by 33% on a compound average basis and paying out literally everything you have, it's a great model, and they're delivering, which is one of the key aspects in this business. Is yes, it goes through cycles, yes, it's going, but in the current cycle that they're in, they are delivering the returns.
Well, maybe let's get your insights then on this particular stock. It sounds like one with many aspects and angles to it, but let's get our expert analysis now, whether to buy, hold, or sell this particular stock. Pete, let's get your thoughts on this one. Buy, hold, sell?
Yeah, I've always liked it. It's in our offshore portfolios. It's done very well there. It's not an all-time high, which always makes it more difficult. But I think it's, it's still good value. You can have, the concern is if conditions get tougher, business like this can be fairly cyclical. But I think that's in the price. At a 10 multiple, an 8% dividend yield is almost unheard of. That would seem to indicate that people don't believe it's sustainable. But it comes down 25%, that's a 6% dividend yield. I'll still take it.
Exactly.
So very happy to buy this share.
Despite it being at $38 last we checked, and Pete mentioning that it is at an all-time high, would you still be buying it at these levels?
Very much so. I think I have to reiterate a lot of things Peter said on it's a great yielding business, it's attractively priced, and one of the key aspects around this as well is you have a very experienced and quality management team. So it's not just one man's hands, it's a great team behind it. They're delivering results in the current environment. They should continue to deliver. As we've pointed out, it is a cyclical business, so if markets do come out or come down for a sustained period of time, we'll have to see how they position themselves. In the current market, current valuations, definitely a buyer.
And 2015 does seem to be a year of opportunities for them?
Very much so. This is a business that we've already said pays out all their money. If they want new money, they go and raise some. They've got a very key interest in energy at the moment with having oil come off so dramatically. There's a lot of quality assets in that space that purely from where they play have come off. So they've gone and raised $9 billion. Their latest fund was 4.5 and was oversubscribed very, very quickly. So it's a well-respected name. They've got opportunities. Credit, where the banks are not picking up, is a great opportunity for them. High net worths into their hedge funds. There's multiple areas where this company has the potential to keep growing this year.
And moving into emerging markets like India, we also see.
Yes.
Exactly. Well, we're happy to hear that you like this stock, and maybe it is one for some other investors, especially you that's watching, to take a look at. Once again, a big thank you to both Peter and Brian for their comments with regard to Blackstone. That's where we leave it for today. Do join us again next time where we talk more stocks.